Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room, live streaming from Ticket Talker. We're going to jump right into the gold market, down about $5 right now. And we have activated actually a buy trigger this morning by coming down to the buy one level. Of 1781. And on this bar, basically, it met the target. It met the target, and it activated a buy trigger. This buy trigger here is a long from 1783.80. Your stop protective level is 1781, and your target automatically is 1790, which is the mean initially. And if you have multiple positions and the market trades above 1790, then you can use the targets above of 1803 to take the balance of the positions of the table. Now, we recommended yesterday or the last this week pretty much that the market was in an area of distribution of supply as it comes up to these levels here in red. And we got up to about 1798 at 6:45 p.m. yesterday, and reverted right back down. Not quite getting up to the 1798.99 sell 2 monthly trigger, but found sellers sooner, which is what the AI prospectively identifies for us as self-directed traders. This signal here, this short signal, the target was 1790. If we take a look at the silver, we actually came into a weekly sell to level of 2672 yesterday by making a high of 2673. And this is when I recommended to lighten up, take profits to all of my traders in my private trading room here for those that are serious traders. Pretty much we recommended, this was at 6:12 a.m. The targets were completed at the expected levels. So I make a point of providing constant intelligence that is produced by the signals of the variable changing price momentum indicator, and I pretty much post all day long. Actually, the signal or the signals here in Discord are produced 23 hours a day. Here you see an example of 2607 target completed. And pretty much I document all the signals that are produced in the Discord trading room for the benefit of my traders that use the VCPMI as a driving tool for their trading. Very much just like a GPS when you go driving here, because that's what this intelligence does. If we take a look at the daily data, we're looking at the average price at 26.39. The extreme above that is the weekly sell one level of 26.72, which the market has not been able to penetrate, and it actually activated a short trigger that I pointed out yesterday in silver. And the sell one level is 26.98 to 27.32 for the day. The extreme levels below the mean are 26.05 to 25.45. Trading around the average price daily recommends self-directed traders to stay neutral. There's no trades. The trade was completed from yesterday. The initial target was completed. And for all intents and purposes, this signal, this weekly signal, 26.72, actually activates the weekly average of 25.70. Right above it, we're looking at the 360-day cycle average of 25.85. And if we go back here, these are the levels that we activated a buy trigger from, with a target of the sell one level on the weekly signal. So we've been pretty much integrating daily, weekly, and monthly signals all within this area here of 25.85 harmonically. And then when the market went through that about 26, it tested the selling or the supply here, came down, reverted right back up above, was a very strong indication that we could complete the sell one level weekly, which we did on the 21st of April. So where we are right now is basically on a weekly short trigger, which activated the target of 26.39, which was completed today at 2:15 a.m. So for day traders, we recommended cover the shorts from 26.72 and go neutral. You know, that's a pretty decent trade from 26.72 to 26.39. Even if you just follow the momentum in terms of the trades and booking profits. We book profits from the extreme below the mean to the extreme above the mean. Now we're neutral, prepared to buy corrections into these levels of 26.05 if we see it, which based on the daily average is active, unless we trade above 26.39. And then what it does is it activates the bullish trend momentum once again, thus activating the targets above of 2672, 2698. And you can see the levels above of 2732 to 2740. Okay, so where do we go from here? The market will tell us. And what the market will tell us is that if we close above 2639, we are activating a bullish trend momentum. So you continue to hold on your core position, you flat the futures, and depending upon your profile, depending upon your inventory, these levels here allow you to be able to manage your inventory, where you can sell and take some profits at the extreme above the mean, or cover some shorts, you might say, or add to the long side when it comes down into the levels in blue, which are the extreme below the mean. So we got the market tell us. Right now, in terms of futures, we're comfortable and flat. And either the market is going to come down to 2605, or it's going to negate this bearishness that's been activating now by trading below the average, by closing above it. The gold market activated it by trigger from 1781. So you can raise your stop, trail your stop now, particularly my trading room traders. If you want to maintain the long position into the target of 1790, just trail your position with a stop. This is the only time that the VCPMI recommends that you use a straight stop. Otherwise, it tells you to use the three choices of stops, which is a close below this level of entry or the pivot below for conservative traders, or second one is you can come in with a fixed dollar stop that is comfortable for you as a self-directed individual or trader based on your profile. And the other one is basically to wait until the close, or if you can afford to carry the risk all the way down to 1768, you can use this level as your protective stop. And if activated, you can add at these levels. So the conservative signal went long at 83.80. We got up to 86.30. Trail your stop. Trail your stop. The initial one would be to break even. Worst case, market comes down, takes you out, you're flat. You break even. The second one, obviously, is the dollar stop. So depending upon your profile, it gives you tremendous flexibility to manage your position. The one thing that it tells you is do not use straight stops, which is contrary to what everybody else out there tells you. So the VCPMI has very specific criteria that if you followed with discipline, it will increase your level of confidence as a trader. It will take the guessing out of the equation because the market is going to do what it's going to do. So it's either going to stop you out or it's going to meet the target. In this case, I think we're getting potentially stopped out if you use a trailing stop. See, so there are different choices that the VCPMI gives you to help you manage the risk, which is really what we're talking about. How do we manage the risk on this trade? Than the conventional wisdom that, you can Google it and read about stops and read about pretty much everything you want to learn about trading. Or I would say to learn the academics of trading. Because trading, it's a big difference between analyzing the markets and trading the markets. That's a skill that you develop. That's an internal skill that you develop as an individual trader, which is and should be different than anybody else because you're different than everybody else as an individual. And not every trader is homogeneous. So you got to measure the risk accordingly based on your profile. You can't generalize it because you can't fit the size accordingly. You can't fit a the right size pretty much is what I'm talking about. You got to have the right shoe size. If you have the wrong shoe size, it's going to be uncomfortable. So you got to make sure that it fits your profile. And it's important that you understand that what this is about, it's about risk management. And depending upon how you develop that skill, it will determine pretty much your success in this business and trading. And for me, personally, I use the VCPMI because it eliminates my emotional basis in my decision-making process. It increases the probabilities automatically just on that basis. And then when you have a mathematical directional probability model, that identifies the extreme levels of the supply and demand, which is the core basis of the function of a market, it creates a very specific structure that you can trade now intelligently. Trade is different than analyzing. Trading is following the market, what the market is telling you. And for all intents and purposes, the algorithm identifies those levels, the pivot points, that when the market in the pivot points relationship occurs, it creates a synergy that is a high probability model or indicator where the shift in the supply and demand pattern could take place, basically, which is what we're talking about. So here we've had sellers, come in from, let's go back to silver here for a minute, which is a little better defined chart. We've had, we met the target from the extreme below the mean, as I said, all through this average price that we recommend you do not trade. You wait, you see the extreme. When the market breaks above it, that's when you go long, and then it activates all the shorter term signals. And so we went long here at 25.85 on a close above it, and automatically we had the weekly level in mind as a target. And here, obviously, other people that have supplies realize this and or are using pretty much very similar algorithms, activated the supply, released the supply, more supply, more supply, more sellers, 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 not enough buy-in to revert that, and you have a downtrend develop until the target is completed. And now this allows the market, supply and demand, to exchange, to trade around the average. More supply trading below the average is bearish, activating the targets below 2605 to 2585. And this is the pattern and the structure clearly defined simply in terms of matching the pivot levels daily, weekly, and monthly, and integrating and identifying that harmonic relationship that is of a high probability model or indicator in terms of direction of price. What I would like to see, obviously what I would like to see and what the market does are two different things. But if we take a look just at the momentum of the market that we're in, obviously you have that basis to support the thesis basically that we made a low here at 2374 on the 31st of March. This was the low of the extreme below the mean, as you can see here. And we activated by triggers here, about 2440, 2502. These are levels that we've had in place this whole week as we trade this whole week. And or the daily, obviously, for the day, the weekly for the week, and it changes weekly. The monthly changes monthly, and the daily changes daily. So looking at the daily picture, even you can see the resistance up here, 2672 being completed, and supply is coming into the market. It brought the market down to the average, and now we're trading below the average, activating the levels below. So you can see the function of the market in terms of its supply and demand. And you can also see where those levels are in relation to the relative implied volatility, that we use based on the average price. So mathematically, once again, the average price is 50-50 standard deviation, which means it can go either way. And that's the reason why the program basically recommends to stay neutral. Just let everybody else trade themselves into this level and allow for whatever direction the market is going to go based on its supply and demand to activate a buy trigger or a sell trigger at the highest probability levels, which is what I choose to do, what I choose to trade as an individual trader. And the VCPMI does give you that option to identify those levels. So, being around the block for a little while here, I don't need the stress of trying to figure out every gyration in the market, as opposed to taking that stress out and just letting the market do what it's going to do. But be prepared when it does to act on it without judgment, robotically, systematically, methodical. And that's the difference, I believe, in determining the success of your trading and not. Obviously, we have a little bit of a correction here in some of the derivative markets here, like Nugget. Dust is up. Obviously, it's a bearish ETF. We've been focusing on GBTC, and the patterns are corrected right now, but it coming down to levels that could be interesting. I am accumulating Bitcoin. I am accumulating it through the Grayscale Investment Trust, GBTC. It's an incredible trading asset, and I use it to generate liquidity. But it is a very volatile instrument, so we need to be aware of that volatility and trade it accordingly. But I do, and as you can see, we're into a buy mode and waiting for additional buy triggers to add to my position here on GBTC. The equity markets are in an area of resistance, reverting back down, but still in record territory. And so it looks like we've activated a short signal from the 4165 level here, with a target of 4145 or 4146, which is the average price for the day. But it is in a bearish mode, short trigger. Let's watch the market trade here a little bit as it tries to define basically the daily momentum here from the extreme levels now that we've come down to below the mean on the gold market. The silver seems to be weaker today than the gold market. The gold market is activating buy triggers from buy one of 1781, while the silver is trading below the average of 2638. So It's a question of whether the gold market is now reverting and leading the way up, and then silver would follow, or silver is leading the way down into a deeper correction. So we have a kind of a mixed signal, as you can see, between the silver and the gold market right now. The 10-year note is fairly quiet here, but it has come down from the high that we saw of 177 here just a little bit ago. Down about 0.87 today, slightly lower, down about 1.5 ticks, one and a half ticks approximately. But you can see potentially, a corrective pattern in the 10-year note, which is actually very bullish for the metals. It's very bullish for the stock market. It's taking the pressure of high interest rates and the cost of financing things. It's releasing some of the pressure that came into the market when we saw interest rates shot up to about 176, 177 here not too long ago. So obviously, the cost of money plays a very important role in the market here, in terms of, being able to margin, to buy on margin and borrow on margin. And pretty much determines the cost of everything. Let's just watch it for a little bit here. Let the market come to us. Let's see what the daily momentum develops, whether we see the gold market now leading the way up. And I think the confirmation of that will be by the market closing above the average of 26.38 on the silver market. It looks like gold is leading the way. 1789, 1790 is the target for gold. Trading about 26.39 on silver will activate the bullish trend momentum, supporting the strength in the gold market. Very nice bias here. 34 traded in silver. 86.20 on the gold. Yeah, if you have any profits, if you took the short recommendation, it would be a great time to be covering that. And obviously, getting on the long side based on the gold signal. As it looks like the gold market is leading the way. '87 traded on the gold market here. Continue to trail your position in gold with a trailing stop. The target is 1790. Picking up some volatility here in gold. 87.10 traded. $87.50 traded. Looks like we're picking up a little volume. Some buying coming in here, and silver is picking up momentum again. So it does look like we're getting some buyers coming into this market. volatility picking up momentum, fast market possibly developing. Be aware of fast market possibly developing. Fast market to the upside. The target is 1790 on the gold. $37.50 traded on silver. Looks pretty bullish to me. Yeah, it looks like the gold is leading the way here on this reversion, on this reversal. Even the Bollinger Bands pretty much almost match the average price into that 1790 area. So it's 1789.40 on the Bollinger Band. So the market is being supported, pretty much by Bollinger Bands. And as you can see, the intelligence of the VCPMI is built into this AI that I'm teaching you. I'm reverse engineering the code that was written in C++, easy language, for you, for your benefit as a self-directed individual. And I'm breaking down to you the process that is executed by the robot, pretty much. And these signals that I'm sharing with you here are exactly the signals produced by the algorithm. And if you watch some of the videos that I've done over the past couple of years, over 336 live segments here, you will see a continuous mantra that is produced by the VCPMI, and essentially is sell the extreme above the mean and buy the extreme below the mean. And the market volatility will, identify either the extreme above or below. And the function of the supply and demand will create the volatility that drives the market into this pivot levels that activate these trigger points. And it's a pretty complex program represented very simply by the function of these pivot levels, which are a little more than just pivot levels, because pivot levels don't have a color. They don't identify the, support, the extremes, the trigger points, and so on and so forth. They just support in resistance levels. The AI goes beyond the one-dimensional understanding of pivot points into a more active directional algorithm that you can use as a GPS, that you can measure based upon your profile, how you manage that risk that's identified by the VCPMI. And it's not a perfect science, guys. It's not a perfect science. I don't have the crystal ball. This is not a crystal ball. It's a probability model that identifies the probabilities mathematically. And when you begin to see the beta tested high percentages of reversion to the mean occurring in this structure created by a perfect Fibonacci structure, then you can step away from trying to guess where the market is going because the robot does all the work. And this is the great thing about where we are right now in technology, that we can expedite the analytical process to a point where it's instant and prospective, instantly and prospective. And that goes a lot to say, having to analyze the market, you might say, emotionally, because sometimes when you use emotion and a confused fundamental picture, which is where we are right now, it's the perfect formula for a disaster. So you want to step away from that, let the sentiment, let the majority, let the 90% of people do that, and use the VCPMI to trade against that sentiment. The gold market is a highly technical market as opposed to a fundamental market. And after trading it for so many years, you begin to realize that there is a pattern that unfolds, which is pretty distinct. For example, the gold market has a 5-way pattern annually that you can identify. Within a very close proximity, we're looking at potentially using that cycle analysis at a potential top coming up within a week or two. By the 29th of April, potentially, it is the seasonal top that occurs in the gold market every year. And this is the completion of the first wave from pretty much the bottom that we looked at, 1677. And so as we move into this period of next week, we want to be able to use this rally, if activated, to lock in some additional profits. And now, potentially, what I'm looking at is that it would be ideal if we complete this pattern by going into that 1800 to 1803 level, as high as 1812 based on the daily signals. And if we move up into these levels here, then you can see the harmonic relationship of the weekly and the monthly are very strong in place, and then the daily will trade against that as we move into next week. So based on the gold market, we're looking at the buy trigger now activating the average price, and if we trade above the average price of 1790, then we're looking at a target of 1800 to 1812, which is where I would recommend to unload some of your profits that you have, and even maybe even a 50% reduction in your long position, and be able to buy it back sometime in May, or whenever the VCPMI identifies those levels, like it is right now. So I, as a trader, try not to anticipate things. Let the market come in, validate it, confirm it, or negate it, and then identifies the trigger point, and it's obviously up to every self-directed individual to decide how you want to take that risk. It's not just buy the market or sell the market. It's a very defined, specific, methodical, systematic structure mathematically that identifies the relative implied volatility to the mean. The sell one level is 50-90% relative implied volatility to the mean. The mean is a 50-50 standard deviation. The buy one level is a 50-90% standard deviation to the mean relative to the mean with a 1-to-1 factor. The buy two levels are a 2-to-1 factor with a 50-95% relative implied volatility to the mean. So this is what I need for me to identify basically the trading opportunities as I look at this market daily, weekly, and monthly. Little pause for profit taken here, but very strong patterns developing here. I'm looking at this geometric configuration here that we're building up that seems to be a little bit of an ascending wedge, which is a sort of a bearish indication, with the target projecting to be completed at 1808. But if we do break below this support level of this ascending triangle, it pretty much validates it, particularly closing above 1762, that the downtrend has started. So we are approaching extreme levels of what the AI identifies as potential distribution of supply areas, where we can expect supply to be coming in and sellers potentially to be unfolding. $1,800 to $1,823 is the weekly target, which is active based upon the market trading above 1762. Let's go back to the 15-minute chart that I use for trading purposes, and gives me a much closer picture of where the algorithm is. So for now, we continue to hold our core position in the metals here long, with my targets, as I said, would be in that 1800 1812 area, and I am using the short end of the market here to take advantage of any short triggers against my core position. I think we have potentially one more counter trend move to resolve the overbought condition of the market. And I think if we are able to get the price to come down into early May, into these levels here, that would be an extremely high probability to get long on the market. I believe that the summer rally potentially will begin the first week of May. Thank you, my friends, for another day, another opportunity to share this with you. And I hope that you are benefiting by this. Every day that you come here, you're becoming a better trader. You take care. Have a great day. I'll talk to you soon.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
Steve Collegian here with John Najarian, folks. We're at Master Control.